Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We have a perfect guest to speak of. Our equity conversation of the day is Stephen Auth. He is with Federated Hermes. We're thrilled that he could join us here this morning. Just as a general statement, and it goes back to the day you and I looked at AOL Time Warner and said, really? Did these deals work out? My answer is no. There's no evidence. They're a value add.
They haven't added a lot of value, Tom. This is an interesting deal.
You got to go longer than that, Steve. It's not TV. You got to have longer answers.
This is an interesting deal, though. I mean, Netflix getting a hold of these studios, I think it could really upend the whole Hollywood industry. I think that's what.
Can it create profit where Federated can invest in it?
We're not in Netflix. Well, we're in all these stocks, but we're not heavy there. We'd rather on these Mag 7 names, we kind of play relative value. And for us right now, Amazon is maybe a better value, if you will. I mean, people talk about a bubble, but you can buy Amazon at 18 times cash flows. It's really not bad for a company that we look at it and say, gee, you're getting AWS, AI, and you're kind of getting the retail business for free.
Yep, absolutely. Steve, 2025 has been a really wonderful year for investors. I mean, 15% in the S&P, 20% in the NASDAQ, fixed income, high single-digit returns. What's kind of the setup for 2026 for you guys?
We think it's pretty good. We've got a 2-year target of 8,600. We've got 7,800 for next year, and really driven by earnings growth at this stage. Okay. We've got earnings at 390 out 3 years. And, stocks eat nominal GDP growth. Nominal GDP growth looks really good to us. You've got the AI revolution driving earnings. You've got enormous productivity. We've got GDP next year up 3%. I think the consensus is 2%. We've been on the high side all along. We've been more right than wrong on that. But, you've got a lot of stimulus coming next year that we think could get you a surprise on the upside. And with the job market relatively stable, that means a big boost in productivity, which is a big boost in earnings. So,
yep.
I think the setup looks pretty good.
Paul, SPX 8,600.
I'm all in.
Is Dow 60,000?
Yeah, we're at 48,000.
I've never done that.
No,
That's a first.
Again, what sectors kind of screen well for you guys, Steve? Because we've had tech has been such a star for so long, and then the AI story over the last 2 or 3 years has been the star. What sectors screen well for you?
Right. So what we're trying to do is we don't want to be out of this AI trade because it's the driver. But we're just modestly overweight those stocks. And again, playing relative value within there. And we think the big picture next year is finally this broadening out happens. The Fed cutting helps the interest rate sensitive parts of the economy that have been suffering. So that starts to lift housing, regional banks, emerging markets actually had a good year this year off of very low levels. We think that's a really interesting place. So we are playing this broadening out trade, but not going underweight or avoiding the drivers of this thing, which are the tech stocks. But we think they're going to be becoming a relative value play within there. We don't really see them as necessarily leading the market forward next year.
Help us with the gloom that's out there. We have 3 years of double-digit return. People are modeling a 4th year of double-digit return. It's like 3 times, Paul, since World War II, we've had this oddity. How should people cautious, including clients of Federated, how should they be enthusiastic if they don't feel that way?
Well, what we've been saying, Tom, is we're in a secular bull market here. This is only the 3rd one in the last 100 years. They happen after you've had a 15-year bear where everyone is lost a lot of money, which they did between 99 and 13, and they're forever cautious for a generation.
The scar. And that's it's like depression babies.
Right. That's what drives the bull. And that's why here, as soon as we get a little bit of a pop, everyone's talking about bubbles. We put out on our website earlier this week a bubble monitor. Because in our experience, you've got to look at bubbles from the perspective of several different dimensions that tend to happen kind of in conjunction with one another, not just one. So overinvestment, one people talk a lot about, but excess liquidity, we're not there. Actually, the Fed's probably too tight. Regulatory errors, we're not there. Overinvestment, you could sort of make the case maybe, but if you look at the levels of investment relative to GDP in this phase, it's still below what you saw in the other big industrial revolutions. And it's being funded by cash. Excess debt, we're not there. And overvaluations, we just went through the story on Amazon. I don't think we're there yet either. So we've got a few things flashing yellow, a little bit of fraud out there. That's never good. But, we think generally we're early before you start calling for a bubble here.
To get your Wednesday started, Stephen Auth with us. He's with Federated Hermes here on Equities. Got a real equity show. We'll do some bonds with Ira Jersey later on. We'll do some real estate as well. We're doing commodities today.
We can do that.
We'll do commodities as well. Paul Sweeney and Tom Keene, the way you listen to us. Thank you, 99.1 FM, Nathan Hager Radio in Washington, 92.9 FM in Boston, Bloomberg 1130 here, and of course on YouTube. Subscribe. The way you do this, somebody asked me the other day, how do I get you on YouTube?
Okay.
Here's the way you go on Bloomberg Podcasts. Up comes Bloomberg Podcasts. We do the live show every morning. Subscribe to Bloomberg Podcasts on YouTube to see handsome Steve Auth.
Yeah, just click a button. There you go. Steve, how about U.S. equities versus maybe rest of world equities? We had a little bit of a migration earlier in the year out of the U.S., maybe into Europe and some other markets. How do you think about that?
Yeah, I mean, those markets were really cheap, and a lot of it was actually a currency play.
Okay, yeah.
Because, that was a big move. I just came back in September. I was out in Japan with our Japanese analysts, and just came back last week from a long trip out to Europe, talking to folks out there. So I'm a little fresh on that. And I would say this. If you look at IFA, which is a technical term for basically the developed world outside the U.S., Europe looks okay to us. It's not as cheap as it used to be relative to the U.S. It's still relatively inexpensive. And the downside isn't really there. The economy, the governments are spending more money thanks to President Trump on defense. But on the other hand, there's not a lot of upside, and there's not a lot of AI technology in Europe. So it's kind of backstage. We think it's okay. Japan is really interesting. It's restructuring. The first time the real estate market's finally come back after 30 years. Tom, you probably remember the days when Tokyo real estate was more expensive than all of the United States, et cetera. But it's starting to really come back now. So we think that's interesting. But basically, the way we're staged here is we're modestly overweight so-called IFA developed because of Japan. We're overweight EM because emerging markets is the only place outside the U.S. where you can get technology stocks, basically in Asia. And we think that looks interesting. We think Latin America next year looks pretty interesting. So we're overweight there. But our big overweights remain in the U.S. because that's where, this is the leaders here in this industrial revolution.
You're paying up for it, right? I mean, the valuation here is just extraordinary, isn't it?
As I said earlier, I think on the Mag 7, in some cases but there's other ones in there that look pretty valuable and pretty cheap. And then on the other side of it, the rest of the broader market actually is inexpensive. So we think in the U.S., the big story next year is finally this broadening out trade. Right. It's going to benefit from these rate cuts from the Fed, the regional banks, the housing sector, the industrials. So, we're playing the broadening out trade in the U.S., hanging in there with the U.S. tech stocks, but trading relative value, and then looking outside for more tech in Asia.
Let's go William Priest here. What is the Steve Auth? What is the Steve Auth process to identify quality free cash flow growth?
Right. So, people talk about quality. And I had never met a PM in my life who didn't say he buys quality stocks. So, you got to define it so that we start with a management team that we believe in and has a track record of growth. The second is we look at cash flows being generated by the business and a business position that can sustain and protect those cash flows. And we want to see cash flows. We want to see pretty good, solid balance sheets. We don't want to see people playing around with fake earnings.
Because of time, I got to bring this up, folks. This is so important what you're hearing here. This is like the mistakes that are made out there. The fundamental underlying of quality free cash flow is the partial differential of revenue growth. what you started with on nominal GDP.
Absolutely.
If you don't have a revenue growth beeps above norm, however you want, fan distribution, whatever, if you don't have revenue growth, you can't get down to the bottom to free
You can't get cash flow.
Yeah. It's just that simple, Paul. I can't say nominal GDP is where I am.
Hey, Steve, we just had the biggest IPO of the year price last night, Medline.
I missed this. What is it?
I mean, $6.3 billion IPO. That's got to be kind of a bullish sign, right? I mean, it just seems like if you're raising that kind of capital in this market for a traditional healthcare company, what do you make of that?
The middle syllable of economy is confidence.
Yep.
So you're absolutely right, Paul, with that question. It's something when I review everything that's going on with our board every quarter, our clients, I look at IPO activity, M&A activity. Of late, I found myself kind of as the receptionist at Federated Hermes after 5 p.m. when the regular staff goes home and you've got these roadshows coming through. And it's, Steve is introducing people to you. But, there's a lot of activity there. We're nowhere near back the bubble days, if you will, when things were really popping.
3 lunches on Tuesday.
I love to see this activity because to me it's a sign that animal spirits are coming back into the economy. And that's what drives everything else.
Medline, MDL, and thank you, Paul. I missed this completely. Did you get your 8,000 shares?
Yeah, sure. Absolutely.
Okay, I just want to be sure you're taken care of. But this is like, Paul, this is like the way it used to be.
Yeah.
I mean, and you said
we're seeing some M&A activity out there. We're seeing some IPO activity out there. A lot of that or suggests that the market's pretty comfortable with where things are right here. So
okay.
Take a look at that thing.
Steve, wonderful to have you in. Thank you.
Likewise,
Don't
thank
be a stranger. Stephen Auth, a legend at Princeton, at Federated Hermes. Thrilled that he could come in. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
One of my great inventions is the phrase chart, paragraph, chart. It came out of Bear Stearns and Goldman Sachs years ago. John Riding's work, David Malpass's work, Jan Hatzius and Dudley and the team there. Carrying on that tradition, Eric Winograd is brilliant at AllianceBernstein doing the chart, paragraph thing. I want to get to aggregate paycheck in a moment. Steve Auth, our new guest, just came in with a wild 2-year optimism on the equity market, and the equivalent Dow is Dow 59,000, 60,000, and he pins it off nominal GDP. Discuss current GDP, real GDP plus the inflation component. What do you see out 2 years?
Well, so I think that's the important part of that is the inflation component, right? Nominal GDP has been elevated this year because inflation has been sticky. With inflation still running 3%, nominal GDP is going to be higher. And Steve is right. Equities benefit from higher nominal GDP. So that all makes sense. The question on a forward basis is if inflation comes down, as we expect that it will, what does real GDP do? What does real growth do? And I think the jury's out on that. You can tell optimistic stories around AI and the boost to productivity. History tells you it usually takes longer than a year or two for these technological advances to really manifest themselves in terms of massive productivity growth. So we share the idea that the economy will continue to expand. I would say that we are not quite as optimistic as Steve seems to be. I'm an economist, so sort of I lose my guild card if I'm too optimistic about anything.
It's switch December. We're asking economists what the market will do, and we're asking strategists and managers what the economy will do. Paul,
Eric, what do you make of the labor data we got yesterday?
So I don't think the labor market data really changed our picture of the economy, right? The labor market is certainly a lot slower than it was 6-9 months ago. We're in a low hire, low fire economy. I think people are aware of that. I think that it is, I would phrase it as sort of precariously balanced in the sense that labor supply has been constrained by migration policy and labor demand has been constrained by a variety of different factors. And so we're sort of sitting close to a neutral-ish level at a lower level of hiring. What I do take information from, though, is that it is only close to balanced. The unemployment rate has gone up for several months in a row now, is at a new cycle high. And that tells you that labor demand is falling faster than labor supply. It's not a lot faster, but it is faster. And to me, that's the primary driver of why I expect the Fed to cut as we move through next year.
We're going to get some inflation data tomorrow there. How do you view that? What are you expecting to see tomorrow?
Again, the evidence that we have, and this is the first week that we've gotten data since the government shutdown ended, the evidence that we have from private sector sources from other places is that the economy didn't change meaningfully during the shutdown. I expect the inflation data to show that, which is to say that it's going to be sticky. I don't think we should expect a dramatic change from where we were before. Goods prices are elevated because of tariffs. Services prices are coming down, but only slowly. We're still stuck sort of around 3%.
Right.
And it won't be until next year that we see real progress on that.
A lot of good analysis yesterday. It's really, really valuable out on LinkedIn and Twitter. Eric Winograd, I love your phrase, aggregate paycheck. That's sort of how each and every house listening and watching the show feels. There's like the aggregate paycheck into the house. Do we risk a negative real aggregate paycheck?
We've been close at different times this year. And,
I agree.
That's where inflation really starts to bite because salaries adjust, but they don't adjust as quickly as prices do. And so you have at various times this year been dancing with the idea of households losing ground in aggregate, right? So this doesn't mean every household, but some households losing ground relative to where prices are. Right now, we're sitting on a 6-month annualized basis just above zero. And to me, that's the primary driver of the economy. We can talk about CapEx investment, we can talk about AI and all that. At the end of the day, this is still a consumer-driven economy. And if the household paycheck doesn't stay above water, things start to look pretty dangerous.
Then at Dartmouth College, when you looked at this, you bring it over to the political mandate. If we have flat real wages, a crushing aggregate paycheck in America, that really drives the central bank to a more accommodative strategy, right?
Well, it should do, right? It's a challenge for the central bank because if the reason that the paycheck is running close to zero is that inflation is too high, it's not clear that they're supposed to cut rates, right? Maybe they're supposed to stay tight and address it through the inflation side of the mandate. I think Chair Powell's been eloquent in talking about this and saying that the Fed is being pulled away from its mandate in both directions. That's why you see the discord within the Fed. That's why you see dissents in both directions. There is some evidence of economic weakness. There is also evidence of inflation stickiness. And so it's not clear what they're supposed to do. But Tom, when you say, this brings up the political side of things, we have not had to think about this for a while, but we will as the year progresses. We're rolling toward midterm elections. And, with affordability looking likely to be one of the primary issues, it's not clear how the American public will react in a political sense if the paycheck were to fall into negative territory or if they were to feel that things are deteriorating.
You say that the run rate of hiring has clearly slowed this year and remains weak by historical standards. Why is that?
So I think there's a couple of aspects to that. One is that labor supply has slowed. There are fewer workers available. Another part of it is that businesses have gotten a little fat on labor. I think that people hired and, rewind a few years when we were here talking about labor shortages and businesses couldn't find people. As a result, once they found them, they've been very reluctant to let them go. So businesses have been running at full staff for a while, which diminishes their hiring needs. But the primary driver, I think, has been economic uncertainty. Businesses have not wanted to hire in an environment where they don't know the policy regime. The month, if you have to pick a month where hiring really deteriorated the most and moved into this lower trajectory, it was April, right after the tariff announcements. Right. And I don't know that that's a reaction to tariffs specifically so much as it is a reaction to the uncertainty.
We do our Eric Winograd Audible here, folks, on China with his work at Dartmouth and their acclaimed Asian Studies program. Deborah Aiken published out of London today for Bloomberg on luxury. And there's a basic idea that the, 3 cities in China that do luxury, Shanghai, Hong Kong, Beijing, I guess it will come back. I'm reading Bloomberg News on the fiscal structure of the Xi administration, the Xi government, and I'm seeing some real stress there. How do you perceive China for Americans into next year?
So from an American perspective, China is not as relevant as it was before because of the tariff policy. There's been a redirection of exports. If you look at China, their trade surplus has hit a record this year, even as their trade into the U.S. has diminished because of tariff policy. They are exporting more to Europe. They are exporting more within Asia. They are exporting more to South America. They have to continue exporting because in order to keep growth positive, they have to continue producing. And domestic demand in China, as we've talked about before, is very weak. So if they're going to produce it and people in China won't buy it and they can't sell it to the U.S., they have to find somewhere else to sell it. And they have. And I find it a little bit ironic that in the U.S. we're talking about the affordability crisis. China is essentially exporting deflation everywhere else in the world because we won't let them export it here anymore. So, look.
That's brilliant.
Yep.
Lisa, write that down, please. That was brilliant. We have chosen not to import their price decline.
Yeah, and look, there may be sound political reasons for that. We've talked about wanting to reshore manufacturing and all of these other things.
I looked at manufacturing jobs in the jobs report, Paul. No. There's no evidence.
We're not yet. And again, this goes back to business uncertainty. We might at some point, part of our forecast for next year is the idea that you'll get a little bit more capex in the U.S. as uncertainty fades. But there's a reason that we were producing stuff offshore in the first place, which is that it's a whole lot cheaper. And if you can produce it a lot cheaper,
right,
then you can sell it a lot cheaper. And so, this idea that you can just sort of cut China out of our production chain and not have it impact prices doesn't make any sense. And we're seeing that.
Eric, thank you so much. AllianceBernstein, Eric Winograd, I can't say enough about his work. He's our chief US economist. We're thrilled to get his perspective. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Stephen Kim is with me. I didn't know you were. How did you end up at Evercore? Did Ed Hyman call up and say, please?
No, it was fortuitous. It was really a great move on my part because so much of my sector is dominated by or influenced by macro, and what better macro shop on the planet is there?
How do you read Ed Hyman? How does a guy like you own the high ground in American housing? What do you read in Ed Hyman where you lean forward?
Well, I think Ed Hyman has phenomenal contacts, and so he hears so much about what people are thinking across pretty much every sector. That gives him an edge, I think, that nobody else can match.
The Fed bet is we get disinflation, and they tight about multifamily housing, single-family housing, everywhere but where Paul Sweeney lives. Mm-hmm. Okay, do you get, just as a beginning conversation, do you agree that housing prices and housing inflation will dampen this year?
100%. My view is that actually you could see existing home prices go retreat a bit. 1 to 2%. I don't think it'll be palpable because you don't. I think that would be very problematic. But I think you could see prices down 1-2% this year, next year, in the existing market, and I think actually that would be positively received. And I think that really what would drive that is homeowners who have been wanting to sell finally saying, you know what? We're going to make the move, and I'm willing to take a little bit of a lower price because I still have significant amounts of home equity. Yep. I think that's something to really watch for in 2026.
Tom, Steve's a player. He doesn't have to schlep into the Evercore ISI offices in New York City. He hangs his shingle in Raleigh, North Carolina, one of the most beautiful parts of the country down there, and he's right next to my Duke, so he can go over there anytime he wants to see some good basketball. Stephen, we have Lennar reported today. Some disappointing numbers. Last night. Some disappointing numbers here. Talk to us about Lennar and what these home building companies are telling you guys these days.
Well, I think the first thing to say up front is that Lennar has a lot of idiosyncratic aspects to it right now. It's very, very fascinating. But there's no question there is a read across. They are the second largest home builder in the country. And it is tough out there. And what they told you was that even though mortgage rates have trended down, it has not stimulated an improvement in home buying demand that was anywhere near what they were hoping for. Okay, so that's certainly an important read across. It generally confirms, frankly, what I think most folks, would have gleaned if they just were sort of paying attention to what the builders have been saying.
All right, as a former director of research, this stuck out at me, Steve. You cover 14 stocks. You've got 14 holds.
I do. Right now, I have. What is going on? We used to be the permable, Okay. And a couple of months ago, we said we still like the long-term potential, but we basically hit the pause button. We said this group cannot be owned. And there was a lot of uncertainty, not only because the market was not responding to the lower rates that we saw coming into September, but also because the government was becoming increasingly interested in and proactive, or talking like they were going to be proactive. And it was very difficult to determine what exactly they might do. Their initial commentary, mostly communicated through Bill Pulte of the FHFA, was not looking good to me or investors. Right now, Bill Pulte is sort of taken a step back, but it is still very uncertain what the government is going to do. And so in that kind of environment, I said, we can't really make a call with conviction. A couple of months have transpired. We're thinking about a few things. So, we'll see what 2026 looks like. But that's the explanation for what's going on right now with the ratings.
Across America this morning, the way you listen to us, Stephen Kim, he is with Evercore ISI on American housing. The research notes, I can't say enough about the acuity. Okay, let's start with this scam. What's a buy down?
So a mortgage rate buy down is an innovation that has actually has its genesis from many years ago. Where simply put, anytime that any of us had gotten a mortgage, at some point we were actually asked, well, how many points do you want to put down? How much money do you want to put down up front to get a little bit of a lower rate? Generally speaking, you put 1% down, or 1 point, they call it, 1% down, and you can buy down the mortgage rate, call it 20, 25 basis points. It depends on, what's happening with the bond market at the time, but something like that. People put 1 or 2 points down. There's a couple of wrinkles, though. One is the seller can sometimes pay for that instead of the buyer. And so these home builders, who are sellers, right, have been doing that so that they can offer a lower rate. But they're not just buying down 1 or 2%, to putting 1 or 2 points down. Right. They're actually sometimes putting down 10 points and, 10% of the loan amount, and buying down the mortgage rate like 150, 200 basis points, this sort of thing. That's what's been going on for most of the last 2 years.
To keep the business going, why don't they just cut price and effect a clean transaction?
So here's the important thing to understand. If you pay 4% of effectively the home price, you can buy down the rate 100 basis points, right? That takes, let's say, the mortgage rate down from, let's say, 7% down to 6%.
Sweeney's taking notes.
I'm taking notes.
All right. That's like a 12% reduction in the mortgage payment, roughly, 10 to 20%, 10 to 12% reduction in the mortgage payment. Well, how would you affect that if you didn't change the rate and you just, lowered the home price? It would be a 1,200 basis point hit, right? You have to lower the price 12% to get a reduction, right? If the rate was the same, right? So which would you rather do? Give up 400 basis points of margin or give up 1,200 basis points in margin? Mm-hmm. Builder said, you know what? I can do that math. I'm going to go with the buy down. It'll cost me less. The buyer's happy. The payment gets reduced the same.
To tie a bow on this, this is legal what's going on.
So it is legal,
right?
But there's a but. It's legal, but the government has set certain limits to how much the seller can pay. And those limits are generally, depending on the mortgage type, 6%, 6 points, or 3 points. But I just told you that the builders were doing 10 points sometimes, even more. How do they do that? Because there's a loophole. If you do your buy down a certain way, called the forward purchase commitment, it's exempt. And with a stroke of a pen, that exemption could be modified or removed. And so we point out this as a potential vulnerability that the builders should think about as we look into 2026 and 2027.
Interesting. We're talking to Stephen Kim, head of housing research at Evercore ISI.
Was that enough inside baseball?
That was some deep stuff. The Mortgage Bankers Association 30-year fixed-year rates like 6.3% or something. Yeah. Is there a rate that's going to prompt sellers to say, all right, I'm ready to sell my house, move down to Florida, wherever I'm going to go, and move down to Raleigh to the Triangle? And is there a rate that will clear this market? Because nobody's putting their house up for sale.
I think that we get that question all the time, as you might imagine, right? There's this locked-in effect of low mortgage rates. Somebody's got like a 3.5% or a 3% mortgage rate. They're loving it, because prevailing, as you said, is 6.3. Yep. This is great. And so people have asked, people initially said, well, all those people are going to die in their homes. They're never going to move, right? That's a little simplistic. The reason why one moves, some of it's financial, a lot of it ain't.
Yep.
A lot of it is, you know what? Mom's getting older. You know, we really need to go see her, or we're not seeing the grandkids enough, or I'm retiring. And yet, there's all kinds of reasons why the house that was good for you 10 years ago is not really that great for you anymore. And I would say that given the incredibly low amount of housing turnover that we've seen, it is very clear that millions of people, we estimate about 4 million people right now, would normally have moved in the last few years, but have not yet.
Yep.
Now, the impetus for them to want to move has not gone away. Those things that I just, retirement, being close to the kids, being close to the aging parents, you know, those are itches that do not go away unless they are scratched and until they are scratched. So we think there is significant pent-up demand.
Yeah, I bet.
Now, that's not a rate thing, though, right? That's a steady pressure that's building, and it's going to keep building until they actually move. I think, therefore, that we should think about the unlock with respect to rates is it's not binary. There's not like a magic rate. But certainly rates going lower makes it a little bit easier. You leave a little less money on the table. But meanwhile, it's really these life factors that I think are more important.
And it's unfair to you, you know, with Evercore, you know, you look at National and you've got, you know, your list of companies. And that if you had a cup of coffee right now with a new mayor in New York City, or with the governor of New York, the governors of the tri-state area, this American housing crisis is tangible. What's the Stephen Kim's solution for Queens? What's the solution for Kansas City? What's the solution for LA?
Well, one of the reasons why I'm not in politics, there are many, by the way, but one of the reasons is because I don't think that the housing market is really lends itself to a quick fix. There are fixes, but the fix comes from supply. You need to increase supply. And if you do that, you will put some downward pressure on pricing. However, if pricing goes negative full retreat, you're going to kill demand, because who wants to buy a leveraged, you know, get themselves into a significantly leveraged transaction when prices are going down, right? Your home equity is the first hit, right? So that's why I would say Goldilocks is a price reduction across the market, 1-2%, adding supply, and you're going to work yourself out of this thing eventually, but it's not a quick fix.
Research Triangle Park. It's Raleigh, Durham, Chapel Hill, North Carolina. It's been a great market for 40 years.
Yes.
How is it today?
It's very good. You have a lot of in-migration from places like New York, but much more so, I would say, the D.C. market. Most of the people that I run into are generally from D.C., some Chicago, some California. There's a lot of tech. There's a diversified employment base there. It's also the state capital. Yep. You have the 3 major universities, NC State, UNC, and Duke, that are there. So it's a great market.
Right. We had the CEO of Corn and Steers in earlier. What's it, real estate to hear something? Yeah. And, he talked about the culture of management. So to go to a Stephen Kim single best buy, I assume that's wrapped around management as well. Which is the superior operating officer of home builders right now?
I think in the home building arena, I think it's pretty clear that D.R. Horton has an exceptional management team. They demonstrated that.
What's their distinction? What do they do different?
Well, it's a really good question, because it's not just one thing. But through decades of managing their company, they have successfully migrated from being sort of a scrappy entrepreneurial kind of company to being a more large-scale but still entrepreneurial company. Yeah. And they have made some very savvy bets without necessarily dictating it just from the top. So their skill is in home building. So much of the decision making has to happen locally, and they've been able to incentivize their people and empower those people to make really good decisions. That's hard.
Paul, 10-year track record, 18.9% per year. Yep. It's trading like Apple Computers.
Exactly.
I think they nailed 2x4s together.
I tell you, the nail gun, Tom, that has revolutionized home building. I see these people frame up a house in like 15 minutes now. It's unbelievable.
I've been on a construction site as a kid. They gave me a hammer. Tom, go to lunch early. That was the assumption.
Good stuff. Real quickly, cost of building a house. Is lumber going? I mean, where are we on just the cost of building a house these days?
So, we certainly have seen some material inflation. However, lumber has actually been very well contained, and labor has also been surprisingly well contained. Going into the year, we thought, oh my goodness, with all the deportations and all that rhetoric, that we were going to see a lot of the laborers disappear, and no, didn't happen.
Why didn't that happen? Because that was always called out. Your industry.
It was. One of the things is that the multifamily starts dropped significantly because you had kind of a boom there like a few years ago, and then that came down, and a lot of the same workers, who are there's no multifamily, well, then they go to single family, so that's part of it. And then second of all, the guys, the guys who might be afraid when ICE shows up, that keeps them away for a couple of days or something. But you know what? If they don't work, they don't eat.
Yeah.
Right. So they're very tenacious.
All right. Yep. Stephen, thank you so much for coming.
Thanks
Stephen
for having
Kim
me.
is head of housing research at Evercore ISI. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Sweeney and Tom Keene. Paul, like Wednesday before the holidays, Lisa's got the party dress on.
Yep.
I mean,
Exactly.
you can't see this on Bloomberg.
Sure.
Is it 2 or 3 parties tonight?
It's 2.
Yes.
Okay.
But the dress was a steal.
Okay. So, what do you have for the newspapers today?
Okay, speaking of a steal, you know how I always talk about the Costco hot dog, $1.50 deal, okay? But the Wall Street Journal says you have to check out their vacation deals. I'm telling you, I almost booked my trip to Greece through Costco, okay? Because of the offers. It's actually been around for a while. Like Costco started dabbling about 25 years ago. Yeah. You walk out and there's huge advertisements everywhere. It has like 800 in-house agents, 13 buyers, 5 call managers. I mean, it's multi-million-dollar. It's not just booking and vacation packages, but it's cruises, it's rental cars. It's like the whole.
Has they always? I didn't know this was a thing.
Yeah, I get my rental cars through there. Yeah. But
and you feel like you're saving money.
I am, because I compared it. I mean, granted, I'm paying for the membership. And that's the thing. You have to be a member in order to get the vacation. It comes with a few. It's not Expedia. It's not Booking.com. It's not that big. But you get like airline tickets through a package, so you don't get to kind of choose the exact airline. It's kind of like Costco. You go there and you get what you get, and you don't get upset. As my mom used to say.
Actually, we should say, folks, surveillance. Lisa Mateo is not have a business affiliation with Costco.
No.
Except what's your record number of shopping carts?
3? 1.5.
Oh, come on, 3. You got radar. You got red lights in the back one here, so you don't take someone out in vegetables. Next,
it gets dangerous. Okay, global coffee prices. Right, we've been talking about it. They've been going higher and higher. Unreal. Yes, for that cup of coffee. But I mean, let's face it. You can't kick the caffeine habit, right? So what Bloomberg has this article in the terminal. It says what more people are doing to make the cup more affordable. So they say drinkers are kind of trading down, like they're choosing the cheaper drive-through options. Maybe they're going to convenience store coffee instead. Don't knock the Wawa. They have really good coffee. Cutting back on the number of times they make the coffee run too. That's another thing. And then you have the real diehard coffee fans who are going for, they're buying the grinders, right? They're buying the drip coffee makers. They're buying the fancy espresso machines. Yeah. Yes, that fill the counter space.
Yep, got nothing left.
Yes. They say it's pricey, up front, but it's worth it because you save in having to go, to the store every day.
I mean, I got the chart. Bloomberg folks just great in commodities. Will Kennedy driving that forward for us pretty much since the bottom of COVID and all that. Paul, ready?
Yep.
Up 367%, 27% per year. That on a quick look at the commodity coffee.
My double short mocha on Saturday when I'm out doing the errands, $5.60. And then I tip $1. So there you go. That's my $6.60 for a double short mocha.
But some people do that.
I do it
daily.
once a week. That's kind of my thing.
Once a week. There you go. That's your thing.
All right. Because we've got again 7,000 different varieties of coffee up on the 6th floor here at Bloomberg from all parts of the world.
Good.
They are very good. I do have to say.
Next.
Okay, this next one, it's how more moms are taking over their adult kids' dating profile.
This is lame.
And this is like the kids' request. So the kids are saying, you know what? I'm tired. I'm burnt out. This is in the Journal.
Go to
they're
a
saying,
bar.
they're saying, Mom, take over my profile. Okay, and it's not just mom. It's dads. It's the brothers and sisters. Even grandma's getting in on the action. Okay, they're redoing their profiles. They're getting them a little bit better. They say it can bring some new perspectives, but there's some challenges too because family members have different opinions, right? I mean, some people go for certain things, other people go for others. I never did. They didn't have this when I was dating. They didn't have these apps. My son does, yeah.
Okay.
He did. It didn't lead to anything. He found his girlfriend through a friend.
Okay.
That's
Yep.
how you
The
do
old
it.
school. Yep. Very good.
I don't know.
I think just go out to a bar.
I think the most intelligent thing
Ladies'
I heard of the newspapers today was just go to a bar.
Exactly. Exactly. The old-fashioned way.
Go to a bar and talk to somebody.
Yep.
Actually talk to someone.
Yeah.
I know.
Put the phone down.
Conversation at home yesterday. Is there a way to get rid of Nintendo Switch? Is there a way to?
No.
Is there an easy
You can't.
formula?
No. They threw a tantrum.
The newspapers with Lisa Mateo. Thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.